Welcome everyone to another video financial understanding podcast with Ted and I. We're looking at Coupang today. There's been a lot of noise about Coupang in the media recently. Full disclosure, I haven't invested in this company yet. I'm looking to see if the circumstances are right and quite frankly, if this is a good buy. But Coupang are essentially, they're considered the Amazon of South Korea. Now, there are a few others like that. Alibaba was mentioned like that. Certainly Mercado Libre, which is in South America. Now, the difference between Coupang and two of its major competitors in the region and in the country as well, is that like Amazon, they have their own fulfillment and logistic centers. So this is a company that's invested a huge amount of money to set up logistic centers all around South Korea. Just to give you an extent, they have about 110 logistic centers, and 70% of South Korea's population live within 7 miles of a logistic center. So that gives them a huge advantage when it comes to cost, when it comes to delivery times. In fact, also when it comes to delivery of fresh food produce, which is a big thing there, and a huge source of competitive advantage. So if you order something by 12 midnight, theoretically, you can have it received by 7 a.m. the next day. So that gives it 7 hours of lead time, which is a really big competitive advantage. They also have their own version of Amazon Prime. So they're really going after that model as a source of competitive advantage. So thank you to one of our viewers, Kerry, for submitting this request. And as we said, as we promise, if you make a request, we'll make the video for you. So if you're watching this and you have some companies you're interested in seeing the finances behind and getting our analysis, send us a note in the comment section. So Ted, what have we found about this very interesting company? They've only just floated on the market earlier this year, correct?
So that's right, Moeed. They have just floated. Unfortunately, as a result of that, we can't get hold of their 10K report, which is the annual report, but we do have their 10Q report, which is now on the screen, which shows the financial performance of the business. So let's go and see how they've performed for the first quarter of 2021 compared with the first quarter of 2020. And then we can think about if they, if we take the first quarter, multiply by 4, that gives us perhaps an approximation as to how they're going to perform for the year, plus a little bit of growth in there. So here are the numbers, and we notice that they've got the retail sales is up at the top. Those are the retail sales, and then they've got a bit of other income. I'm not sure exactly what that is. If you remember, when we looked at Amazon, they had a lot from Amazon Web Services. I don't know whether these guys are providing the same sort of service, but the revenue has increased quarter on quarter by 74%. So that's a significant increase. And, hopefully they're going to be, continuing that acceleration drive. The cost of sales, obviously, we'd expect to go up. And they're keeping a gross margin of about 17–18%. So the gross margin is staying constant as the business grows. The overheads are increasing as we would expect with a growing company. So you mentioned, for example, the additional warehouses, for example, the fulfillment, the staff that they're going to need to employ. And as a result, their operating loss has also increased. So it's not looking so good for these guys. The operating loss has actually increased from -3% to -6%. So maybe that kind of, this number here, this operating costs is a reflection of the investment in people, in technology, in staff. They're building for the future. So, if that is the case, and it would not appear unreasonable to assume that's the case, then I think that's an acceptable aspect of the business. What's also quite interesting about this company is this line here, where they are paying interest. So if they're paying interest, it means that they must have some debt sitting on their balance sheet. Typically, if you're a loss-making business, then it's going to be struggling to get debt. So they're going to have some debt and equity. But it looks like, the banks will have done their research. They'll have checked the, the viability of the business. So if the banks are in there, then we should feel a little bit more confident about this business and its potential for success. So there is the income statement. If we just look at the balance sheet and look at the strength of the balance sheet. So here we go. So remember, this is the balance sheet, is a snapshot as at a particular time. Total assets are about 8.6 billion. Most of those are the current assets here, and they've got a lot of cash sitting in their bank account. So they've got a lot of cash. So even if they are making a loss, and relative to that cash balance, it's a small loss, which means that, this company, they've got plenty of time. They've got lots of, fuel in the tank, so to speak, to get themselves up to speed. High on inventories, but we'd expect that. So, this will be, as we've talked about, an internet fulfillment company. They need to hold that stock ready for when people want to buy it. A little bit of plant and equipment. So this will be, some of their warehouses. Some of them they'll lease, some of them they will own. Accounts payable is very high. We'll talk about that a little bit later on, because this is a significant number. In fact, we'll talk about it now. So the accounts payable is interesting. If we run that through our working capital requirement calculation, it actually tells us that these guys, on average, for the accounts receivable, that's this number up here, the accounts receivable, it's taking them on average 7 days to collect the money. Well, that kind of makes sense, because these guys, if you think about it, when you buy on Amazon, you click, you pay, and then it gets shipped to you. So accounts receivable is not a big issue for these guys. So looking at the accounts payable, so by my calculation, it's about 74 days that they're taking to pay their suppliers. Now that's not unreasonable, but it's quite a long time. So this is a very strong cash flow business model, because effectively what they're doing is that they're getting the inventory in, but it's taking them 130 days to sell that inventory. So it takes them 130 days to sell the inventory. They get the money in almost immediately, which is why they're having to push back on their accounts payable to pay as late as possible, 74 days. And that does not appear, I think, unreasonable for these guys. And once again, we can see the debt. So down the bottom, down here, we see some debt and some convertible notes sitting on their balance sheet, and that's why they are paying the interest. So the last thing to look at is their cash flow statement. And the cash flow statement here is the loss for the quarter that they're making. But here is the cash provided. So they're actually making a cash loss as well. The cash loss has increased, which is not good. However, they're expecting to kind of, start making a profit as the business grows. That we'd expect that cash loss to become a cash profit, and they do have enough cash in the bank in order to be able to fund that. So this is not a company which is a going concern. It's not sailing too close to the wind. It looks like they've got a pretty good a cash balance there to see them through. In terms of their financing activities, that cash in the bank has come through. Here it is. It's the proceeds from the issue of common stock. So that's really driving them. The financing provided by, the cash provided by their financing activities, 3.5 billion. That's the IPO. That's the flotation. And at the same time, a lot of the warrants were actually exercised. So if we go back to the balance sheet, we can see in the balance sheet, for example, that these convertible warrants effectively have disappeared, and they are now in the additional paid-in capital. So we've got convertible warrants and additional shares. They've now got the war chest. The cash balance is significantly increased, and they are ready to start delivering on their business model. So there we see the cash has gone up from about 1.3 billion up to about 4.3 billion. they're ready for it. They're prepared. They've got the cash in the bank. They're growing. They're making a small loss. That small loss is expected to become a profit in the next year or so, and as they start to grow, and then it's really just how much they can capitalize that. Can they dominate the market so that nobody else can get in? Can they deliver? Can they basically do an Amazon? Share price for this company, again, it's going to be quite difficult to kind of work out about, is it cheap? Is it expensive? So we notice there's no price to earnings ratio. This company is valued at $62.5 billion. Remember, that's on a net asset value of it's about $3 billion is the actual total net asset value. So it's all goodwill. Is it worth $62.5 billion? I have no idea. I guess we'd have to look at some of the projections of the company, where they think, what kind of profit figures do they expect to be getting in the next 5 or 10 years, for example, and then sort of, looking at the multiples thereon. So, it's an expensive company. You can see this is the share price. It's been bouncing around for a year. It's been dropping. But it's coming back again just recently. It's on the rise. Have they turned the corner? Are they actually going to start, generating decent amounts of cash?
Yeah, this is a really interesting analysis for a company that's been catching a lot of attention recently, and it's one of the recent companies based in Asia that have floated on the US stock exchange. So it got a lot of press because of that. So would love to hear everyone else's thoughts. I mean, it has potential. One of the big areas for this company is, can it take its business outside of South Korea and expand into other areas? They've already started doing that, actually, although very quietly, in Singapore, which is a densely populated area and has big potential for e-commerce, for this e-commerce company. But who knows, right? We have to look at some of those deliveries that they've made and how they're going to actually work in the business, and if they're going to become successful. We're going to have to wait and see what the results are. So what are your thoughts? Again, like, share, subscribe. Would love to hear your thoughts on this video. Any experts out there in e-commerce world, particularly in Asia Pacific, we'd love to hear from you. And if you have any companies you would like us to analyze for you, whether you're doing business with them, whether you're thinking about investing in them, or even if you've got an interview coming up with them and you want to sound smarter during your interview, leave us a note, let us know, and we will do that video for you. So thank you again, Kerry, for your request. We were happy to fulfill that. Ted, thank you, and we'll wait till the next video. Look forward to it.
Good to speak to you, Moeed. See you later.
Take care.